Hi again, it's me. Like I told you, I'm going to go through a few things with you to try to summarize, break down, look at a different way, Chapter 12 for you guys. I'm going to look first at the accounts, and then I have relationships, and then just other random kind of things. So let's talk accounts first. Bonds payable was our big new account. It is a long-term liability. As all liabilities have, it is a normal credit. And I always use the face amount when I am using bonds payable. So when I issue bonds, I credit bonds payable at face. When I'm retiring bonds or when I call the bonds, I'm going to debit bonds payable at the face. And that's kind of what I just wrote up here again, that it's a credit when I've issued, it's a debit when I've retired or called them, and it's always at the base. Then the discount on bonds payable is a contra long-term liability account. Contra being the key. So contra, opposite of liability, makes it a normal debit, and it goes up as a debit, down as a credit. So when I issue bonds at a discount, I'm going to debit the discount. Again, DD, debit, discount, normal. And then when I'm amortizing those bonds or when the bonds are being called, I'm going to credit that discount on bonds payable because I'm getting rid or amortizing part of it, reducing that balance. So I do that with a credit. The premium on bonds payables, opposite of that. So it's not a contra long-term liability, it's actually another long-term liability. And therefore it has a normal credit. It is issued, or when it's issued at a premium, then it's credited, and when we're amortizing or calling the bonds, it's a debit. And under both of these, it has when they're retired, nothing happens because they're fully amortized at that point. So both the discount on bonds payable and the premium on bonds payable on the date of retirement when it's matured would have a balance of 0, so we wouldn't do anything in the entry for those. Some more accounts for us. We have investment securities, so this is when we're the buyer of the bonds that this is involved, not the seller or the issuer. So it is a long-term asset. Because it is a long-term asset, it has a normal debit, increases on that side and decreases on the opposite. When we purchase investment securities, we're debiting it. And any time that we get the receipt of interest, that semi-annual receipt of interest, when it was issued at a discount, I would debit it. When it was issued at a premium, I would credit it. And we'll go through that later on a transaction. But that's the relationships you need to know. Then interest expense and interest revenue. So when I'm the issuer of the bond, this is what's happening. When I'm the buyer of the bond, this is what's happening. So it's going to be the exact same amount whichever side of the transaction I'm on. So for interest expense, it's an other expense. It's non-operating. As all expenses are, it's a normal debit, increasing as a debit, decreasing as a credit. And other revenues, non-operating, a normal credit, increases as credit, decreases as a debit. And for both of these, you see then that the calculation is the exact same. It's the carrying value times the effective rate on the bond times a half for semi-annual ones. So the carrying value, and this is absolutely crucial, I mean, learn this calculation, is face value of the bond plus premium, deduct discount is the way to do it. So if we're to remember to try to help you. So face value plus premium, deduct discount. Normal balance is debit discount, but when we're doing face value, deduct discount. That's just kind of easy ways to remember it. So if I have a premium, I would add it to the face value, and if I had a discount, I would subtract it. And whatever that number is, that's the amount of our interest expense and our interest revenue if we're the ones receiving the interest payment. Then I just kind of threw these together. So when the bonds get redeemed, the green part, when they're redeemed, it's another expense, non-operating again. And if I'm selling the bond, so the buyer side of it, rather than the issuer, if I'm the buyer, at that point I have a loss on sale. And that loss is an other expense as well. And then I can have a gain on redemption as the issuer, which is other revenue with a normal credit, or I can have a gain on the sale if I'm on the buyer side of the transaction. So just depending on which side. So being able to classify all of them, quite important. So that was all of the different accounts that we got that are new. So now let's talk about some important relationships. And if it were me, I would probably get out the book and look at some of these pages or your slides and write it on. So you had a slide that kind of looked like this, and I know it's not very good, but it's on page 346. And that table and being able to understand that and draw upon that is important. So that table that I was looking at is the one on page 346 for when a bond is issued at a discount. And when it's at a premium, it's on page 348, and it really works completely opposite for a premium than a discount. So let's just talk about the discount side of things. So when a bond is issued at a discount, the cash proceeds, or the amount of cash you get for the bonds that you issue, is less than the face value on those bonds. So at a discount, it's saying I would get maybe $980 on a $1,000 face bond. The bond yield percentage is going to be greater than the stated rate. So the logic of that is that a bondholder is going to pay us less, a discount less, because they're getting a lower interest rate than market rate is. So market's maybe at 8% and they're only getting 7% on the bond. So because they're not getting even what they could get if they invested their money somewhere else, then they would pay a discount. The interest payment is the same amount over the life of the bond. So because when we do our interest payment, we are literally taking that stated rate that never changes for the entire life of the bond. It means that times the face value. Face value doesn't change and the stated interest rate doesn't change. So that interest payment, the credit to cash, stays the same the entire life of the bond. And you can see that on the schedule on page 346 because the interest payment stays at $3,000 the entire time. And then these relationships kind of matter. So I would just memorize this for a discount and then know on the test that it's opposite for premium. So if you look at that table on page 346, you see that the carrying value, which again is bond payable deduct discount, that carrying value is getting bigger over time because we're going from a carrying value of $99,000 back up towards the face amount of $100,000. So it's getting bigger. And then interest expense is also getting bigger because the carrying value is, and the amortization then of the discount, if you look at that amortization on that schedule, it is also getting bigger because more of that is getting amortized over the life of the bond. So those relationships matter a lot. Premium, again, is just going to be opposite. They pay us maybe $110,000 for $100,000 worth of bonds. The bond yield rate is going to be less than the stated rate because the bondholder is willing to pay more because they're getting a higher market rate than the stated rate is. And then the opposite holds true on carrying value. So memorize one or the other. Make sure that you understand those relationships for the test. The last thing then that I want to talk about is other, just some random things. So up here at the top, kind of the key. So this actually says issuer of bonds and buyer of bonds. It's smeared because I dropped it. So when we make an interest payment, the issuer of the bond is going to do this. The one who bought the bond is going to do this. So it's going to be the same amount as the key. So I'm going to credit cash for the face times stated rate times half, like we've talked about. So I always figure that out first. And then we're going to debit interest expense for the carrying value times the effective rate times 1/2. So the market rate versus stated rate. So debit interest expense, credit cash. If I'm on the other side, I've debited cash because I received it, and I've credited interest revenue because I've earned that amount of money. The difference in between here, between interest and the actual payment amount, is either a premium or a discount on bond. And this difference, if I need a debit to make it equal, it's a premium that I'm amortizing, because a premium's normally a credit, so to reduce it and amortize it, I debit it. Or it's a credit that I need to make it equal, then I'm amortizing a discount. Because, again, discounts normally have a debit balance, so to reduce it or amortize it, I need to credit it. So whichever account it takes. If I'm on the buyer side of that, though, that difference is going to the same account. It's just going to investment securities and either increasing it to get it back closer to its face value or decreasing it to bring it down to the face value. And that still really represents amortization. They just use the account, the long-term asset account. Then finally, these last two things are kind of the hard thing. Calling bonds versus converting bonds. Calling bonds, the corporate initiates, and they do it to protect against interest rate declines, because if I'm paying at 10% stated rate and interest rates go down to 4%, I don't want to keep paying at 10%. I'd rather call the bonds. And converting bonds is for the bondholder to initiate if stock price is greater than a conversion price on something. So I'm going to, because I only have a minute or so left, I'm going to end this here and then do just one more quick video.